Hey guys, this is Trade Hunter here from Steady Trades. I'm here to teach you a little bit about supply and demand. So we have to rethink the phrase supply and demand when it comes to stocks, right? When it comes to stocks, supply and demand is the ability and desire of a product and its price. Supply and demand determines the pricing of stocks and other securities. What influences this? Sometimes economic data, sometimes interest rates, corporate results. They all have an influence on the demand for stocks. When it comes to charting this concept, we have to rethink its meaning. The law of demand states when the price of any product increases, then its demand will fall. When its price decreases, then its demand will increase in the market. So if we have a strong demand for a limited supply of available shares, this will push the stock's price up. And the inverse is true for supply. An excessive supply of shares and a weak demand will cause the price to decrease. What are we doing when we're trading supply and demand and looking at supply and demand? We're simply following the money. Institutions own the largest amount of shares. They own $103 trillion in the global asset management industry. As a matter of fact, institutions own about 78% of the market value of the U.S. Russell 3000 and 80% of the large cap S&P 500 index. When we see demand, it means mutual fund managers and other institutional investors who account for the bulk of trading are aggressively buying shares. And it's that strong institutional demand that fuels the stock's big price move. The opposite is true for supply. It's inverse. It means mutual funds are aggressively selling. Is the inverse movement of demand. It fuels the stock's move down. So let's give a general summary of this concept. Supply and demand is simply areas where the most trade participation has happened. The number one thing we have to understand about stock trading, patterns are everything. So let's show you a little bit about these patterns. How do we get what we call supply and demand zones? How do we chart a concept like this? Candlesticks or bars that mark the origin of a strong uptrend are what we call demand zones. They're also called accumulation zones. The inverse is true for supply. These candles or bars that mark the origin of a strong downtrend. That's what we call a supply zone or a distribution zone. How do they show up on a chart? Well, institutions aren't just like regular retail traders. They can't just put their whole order into the market at once because they're accumulating and selling so much that it would move the price too sharply. They're forced to buy or sell in increments within a specified price range. So when the market breaks their order range, this causes their orders to get left unfilled. This will cause visual differences in the charts, which form supply and demand zones. Find the place on the chart where demand overcame supply, or where supply overcame demand. Simply put, where red became green, or green became red. Here's a visual example of what can happen when you implement supply and demand zones into your trading. In this first example, we see a stock moving up towards the supply zone that I have marked in red. That little white circle there shows you where the stock hit this supply zone and immediately rejected. The next example of visuals that we have is where we have new supply zones being formed. We have some consolidation in the price action and then a sharp move downward. This is going to cause orders to get left unfilled, creating these supply zones. The next example that I have are these demand zone bounces. Demand zone here is acting as support. I have it marked in green. The stock comes down, it touches the demand zone, and it immediately bounces, right? So I hope this gives you a general overview on supply and demand, how you might use it, and some visual basics to understanding. As always, if you have any questions, reach out to us anytime at Steady Trades. Happy trading, guys.